The second part of this chapter, internal control and cash, mainly focus on prepare and use a bank reconciliation. So let's start. When you in accounting, we treat the bank account equivalent to cash. Why? Because now 24/7 the corporations or individuals as well can use their cash anytime. So it's a bank account anytime. So it's going to be equivalent to the cash. So what control devices bank is using in order to protect the customer is one is the signature card. So the signature card is a legal document to prove or to protect the identity of a signatory or the account holder. Bank statement is a frequently sending some information that this is your balance, so that the account holder should be aware of the balances, and if there is any ambiguity, so then they can resolve it within a proper time. Deposit slip is a legal document or a documentary evidence for submitting or depositing money, the cash or the check. Bank reconciliation, that's the point we want to discuss in detail. Bank reconciliation is a process firms or corporations adopted in order to find out the actual balance or the accurate balance based on the accounts, the cash ledger, as well as the bank statement. So they find it out the why there is a difference, and if there is a difference is there, they find out that okay, what is the correct balance the according to our books, and what is the correct balance from according to the bank statement, and by this way they reconcile it. So we use the word reconcile if there is any difference among two friends or among wife or husband. So there is a process that we try to reconcile their differences, and this is the same we are using here in accounting as well. Like if there is a differences between two accounts, so we find out that why there's a differences and how we can resolve that difference. Check is again, it's a document or the order, written order by the account holder to the bank to pay. So there are normally, we if we look at in this way, the signature card protect against forgery, deposit slips proof of a transaction, and check has a three parties. One is the maker or the signatory of the check, and definitely the account holder has a right to operate their accounts, as well as some in a corporation, some are the designated second signatories of the checks. So these are the makers or the one who is writing the check. The second party, which is payee, the maker can be a payee here in this way, that if it is drawn in a way that you want to get the cash by yourself, but maker can be a third party to whom the payment is required. And the third stakeholder in the check is the bank itself, and we know that every bank has its own different type of a check. Now, if we look at the bank statement, so this is a very typical format of a bank statement, and here this is an example from a Scotia Bank. The address of the firm, and this is a Scotia Bank. This is the branch of, sorry, the address of the branch of the Scotia Bank, and this is the customer who has a account there. The rest of the things you can see that this is the beginning balance. If it is a account statement for a certain particular month or a period, so this is the beginning balance of that period, and then we have a total deposits during that period, and this is the total withdrawals during that period. And there is, if there is any charges like bank charges for certain services, or bank charges for a particular period, like per month, normally the banks are charging to maintain the accounts. So these are the bank charges, and this is the rest of the, or we can say that this is the ending balance. They also provide a detail that what are the deposits, so individual details that that on what day the deposits, or if there is any electronic fund transfer or a bank collection. So these are the things that they provide detail about the deposits. They also provide the details about the withdrawals, or make payments. So these are the withdrawal details, and there are some other charges which are NSF and EFT insurance. So these are the things, and we see here that this is our ending balance. This is an average balance, which is just to give you an idea, but that's not important. The important thing is that we have this much ending balance. So now, why do we need a bank reconciliation? Because two records of a business cash, the cash account in the general ledger, that in we can say that it is the owner's book or the business books, and the other one is the bank statement or the books of the banks. According to the books of the banks, this is the balance, and according to the books of the account holder, this is the balance, and we want to reconcile it. So amounts are usually different, and the reason behind this difference is mainly the time lag, because there is some time lags when we deposit something. There is a time lag that the check is going to be deposited in our account, and during that time period in our books it's going to be appeared as our balance, but in the banks it is not appearing as a balance. So that's a, or sometimes we issue the check to someone, and the person who is carrying is taking that check is not yet deposited in their bank, so that is going to be debited from our bank account. So for that reason, there is always a difference. So this is what we call it as a time lag, or maybe there is some human error type of thing, like instead of writing 24, 42 is written or something like this, which is also possible. So let's start the bank reconciliation statement. So bank reconciliation statement has the two sides. One side is we start with the balance given by the bank statement, and then we adjust. Uh, what adjustments are made when we are starting with the statement balance as per the bank statement? We have normally three types of adjustments, which one is called as a deposit in transit. So we add all the deposits which are in transit, not yet affecting the bank statement or the bank accounts, but we in our books we reported already that we deposited that money. So deposit in transit, that's the first thing. The second thing is outstanding checks. As I explained, that we issue checks but not yet presented for the payment. So for that reason, there is a difference, and we are reporting here as well. If there is any bank error, it's a error on the bank side. If there is any error, that can also create a difference. So only three adjustments were required in the bank statement so that we can figure it out the correct or the accurate balance. But on the banks, on the books of the owners, we have a certain more adjustments. The first adjustment is if the bank is collecting directly something without that we involved in that. So direct deposit. We know now it is very common that we allow direct deposits, like CRA directly deposited some money in your account, or like a child care or a tax refund. So that's a possible. That's what we call it as a bank collection. So bank collected directly. Electronic fund transfers is also same like a bank collection, but it is electronically someone transferred the money in your bank account. Service charges, if bank charge some amount without your knowledge, so that's what we call it as a without knowledge, means that you know that every but you did not record in your books. So that's what we say. Interest revenue, if you have a saving account, so after every months the bank is going to pay you something as an interest on the balance you keep in your saving accounts. Non-sufficient funds checks, so these are the checks you deposited in your account, but because the one who issued this check has not enough fund to pay, so for that reason the checks were returned. That's what we call it as a non-sufficient fund checks which was returned. It means that you cannot get a money against that check. So non-sufficient funds checks, that's a cost of printed checkbooks. If you get a buy a new checkbook or a more for number of checks in your checkbook, so that's the bank is charging for that. Or if there is any error or a book error, that's a book error. The other side is a bank error, but here is a book error. So if we do, let's start with an example so that we can understand this bank reconciliation in a better way. So you see here, this is the balance according to the bank statement. So in other words, we can say that it is a balance according to the books of the banks. This is the balance according to the cash account of the books of the business, the one who has an account with the bank. So we can see here that this is the bank balance according to the bank statement, and this is the bank balance according to the books of the business, Nixon Partners. Now, how we can reconcile, because there's a difference of around, if we are not correctly, around 26 or $2,500. And additional information, what we are getting is the following reconciling items explain why the two balances differ. So the first thing is deposit in transit. So this much money is in transit. So we added in our account, but bank not yet added because it is in transit. Bank error, that's the second thing. The bank deducted 100 for a check written by another company, so add 1000. So it's by mistake they withdraw this or they charge this money to our account, so it should be added back. And these are outstanding checks, so the total of these outstanding checks is this, but detail is that these are the check numbers, these are the dates, so altogether these are checks which are outstanding. Now what we learned that the we start with the bank balance statement, we add the deposit in transit, we add this error, bank error, which they charged incorrectly to our accounts, so we add this. So this is addition, this is addition, so altogether it's 7,623.14. What we have to subtract? Outstanding checks. So we subtract the outstanding checks. So by this way, this balance which appearing here as 6,273 is the correct balance. And it is still differ from the bank statement, right? Yes, it. Now, if we look at the book side, or we can say that the books of the business, so we see here that EFT, receipt of your rent revenue earned on an investment. So it's a revenue, interest revenue, or EFT. It's a EFT. So it's electronically fund transfer to our account, which we don't enter in our book, so that's missing. Bank collection of your notes receivable, including interest of 214. So that's a total bank notes collection done by the bank, but not entered in our books. 2,114.10, including an interest. Interest revenue earned on bank account balance, so that's a account the bank paid the interest on your balance. So book error, you recorded a check number 33 for 510. The amount you actually paid on account was 150. So add 360 to the book balance because it's a by error. So we write it down 510, but it is 150. So for that reason, 360 is the difference of these two, 510 and 150. The difference of this is 360. We add back because that's a mistake. Service charges, bank charges is 14.25, and non-sufficient fund checks for a customer of 52,000, subtract from your book balance by because it is returned. EFT, payment of insurance, so electronically bank paid. So normally we do this outstanding instruction in our accounts, so that every month or every some period this much amount of money is automatically transferred to others. So that's a. Now what we did, we take this balance, which is a book balance. If I take you back there, you see in the beginning we mentioned this is our books balance. So now we started with the books balance because we are dealing on the book side. So you see here we start with the book balance, and then what we add EFT, receipt of a rent revenue, add notes receivable received, add interest received from the bank, and then add the error, the book error. So we all together it is 6,725. Now what we have to subtract? Service charges, NSF check, and payment of insurance. So when we subtract this all together, like a 427.25, so we see here there's 6,273. So if you look at this 6,273. So this is the objective of a bank reconciliation, that we arrive on a balance which is a correct balance in both our books, in our books as well as in the bank statement. The check available for that, whether you did the bank reconciliation correctly or incorrectly, these two balances should tally with each other. So in a summary way, we can say that bank balance always, what we do three types of adjustments in our bank statement balance. One is add deposit in transit, all the deposits in transit, subtract outstanding checks, and adjust for the error if there is an error according to the error. So sometimes we add, sometimes we deduct based on that type of an error. On the other side, when we start with the book balance, always what we do, we add bank collections. If any money is collected on the banks, add interest revenue and as EFT, electronic fund transfer, and subtract what we has service charges, NSF, check, or EFT payments. So the EFT receipts and EFT payments. So receipts are added and payments are subtracted. Add or subtract correction of the bank. Again, the book error is dependent with what type of error it is. Sometimes it's going to be added or sometimes it's going to be subtracted. Now, because we cannot do any change in the bank's books, we only change in our books. So for that reason, whatever the adjustments we are doing or whatever the things which we missed in order to arrive at a actual balance, so like here we made these types of adjustments, so we have to record this statement is not enough. We have to pass journal entries, so that is going to be the cash balance is going to be, or the bank balance is going to be adjusted correctly. So all items on the book side of the bank reconciliation required journal entries. If the item is added to book side, so debit cash. If the item is subtracted from the book side, then credit cash. So we are just telling about what we do. We add, we debit cash or credit cash. The rest of the things like is we here received interest. So what we do, we debit cash and interest revenue credit. If we make payments for insurance premiums, so debit insurance premiums expense debit and credit cash. So by this way we can do this. Here is an example, like we debit cash and interest revenue credit, debit cash notes receivable and interest revenue credit, debit cash and interest revenue credit, debit cash and accounts. So these are all the same entries what we 28.01 to 114, out of which 1900 is notes receivable and 214 is the interest. This is the interest revenue deposit in the bank. These are the expense entries, or the subtraction, the entries which we subtracted in our bank reconciliation. So bank charges expense debit, cash credit, accounts receivable L Ross debit, cash credit because a return of a check, insurance expense debit, cash credit. What we did is a notes receivable, accounts receivable debit and cash credit. So this is all what I want to discuss from this part. I hope you understand it, and if you have any question, you write it below the comments. Thank you very much.